Hello everyone, welcome to ShailajaIAS and welcome to the PYQ Decoder course. Today we are taking class 4 of the Indian economy and social development. Today we will be discussing key themes in the class 4, that is financial market, capital market and with related to investment. We already saw monetary policy, banking systems, capital market, money market, financial market. Majority of the questions are coming every year. 4 or 5 questions come in this area. So we'll deal with this financial market, capital market and with related to investment, important terms and how questions has been set and which are the areas questions are asked again and again. Chalo, shuru karte hain. We'll see. One question is with respect to investment always and the funds of investment. Alternative investment funds is the question. We'll see the question. With reference to investments, consider the following: bonds, hedge funds, stocks and venture capital. How many of the above treated as alternative investment funds? In economy, when they have given try to decode alternative investment funds versus traditional funds. Bonds, are they alternative investment funds or traditional funds? Bonds will come under traditional, right? Bonds has been issued by Government of India, government securities, treasury bills, by primary dealers, by companies. Bonds have been issued. Next, hedge funds. Hedge funds are not a traditional one. If you have studied economy, if you know the fundamentals, you know hedge funds are a alternative investment funds. Stocks has been there for many years and it's a equity fund. It's a equity funds, and if it crosses 10%, then it will be considered as FDI or investment. Okay, more than 10% it will be considered as an investment. Then you have venture capital. Okay, angel capital, venture capital. In the startup world, all these are funds accessed by startups. Those works as alternative funds, which is angel funds and venture capital funds access alternative funds. Once you know the concept and which are the traditional funds, which are the alternative funds, you will be able to decode. Here, answer is only 2. Only 2. Hedge funds and venture funds are considered as alternative investment funds in India. So, important, the funds in the financial market, in the money market, how the startup is accessing, all these are interlinked themes where 1-2 questions might show up. Next theme is bondholders. Again, the previous question in 2025, we saw about alternative investment funds linked with bond market, stock market, okay, capital market, venture funds, angel investment. Here, question has been asked clarity with respect to bondholders versus stockholders or shareholders. So, corporate finance is the theme asked in 2025. So what is the question? Statement 1, bondholders face lower risk than stockholders. So what is bondholders and what is stockholders? Bondholders is where you are taking the bond of the company. It's essentially a loan and you will be paid interest paid, plus you will be promised to pay the principal. Okay. It's like if you have taken a loan in the bank, you have to pay interest and you have to pay back the loan. Normally, this is more secure. And stockholder means in stock market, say for example, you can directly invest, or if it is a public listed, where it is listed in BSE and NSE, controlled by SEBI. Okay, stock market is regulated by SEBI, Security Exchange Board of India. Stockholders hold shares of company. You might be listening when recently Iran war happened, stock market collapsed and share value came down and investors lost so much of money. Therefore, Based on this understanding, we'll see bondholders face lower risk than stockholders. Yes. Next, statement 2, bondholders are lenders, stockholders are owners. Yes, you're owning the share, owning a piece of the company. Statement 2 is also correct. Statement 3, for repayment purpose, bondholders are prioritized over stockholders by a company. Correct. Statement 2 is also correct and statement 3 is also correct, and both are explaining statement 1, why bondholders face lower risk than stockholders. Bondholders, you're not taking any risk, just you're giving a loan and making sure they pay back with interest. Whereas shareholders, you're taking that risk. Okay. Which of the, in previous funds, risk is involved? Venture capital, angel capital, risk is involved, because if the company fails, the investment also might not be returned back. So here, statement 2 and 3 are correct and it explains statement 1. So, answer. You might have read 1000 pages of economy, but basic concepts, if it is not clear, you will not be able to answer the questions. Just basic important concepts where economy is focusing, if you are able to understand those concepts and go to examination hall, you'll be able to get much good numbers than reading 800-900 pages of content. So, bondholders versus stockholders, important concepts in money market and financial stock market or capital market. Next, financial market question has been come. And who are the players in the financial market? Question has been asked every day. Okay, every time. In 2024, NBFCs, non-banking financial companies, can access the liquidity adjustment facility window of RBI. See, RBI, whenever banks, scheduled commercial banks, okay, and primary dealers are facing short-term liquidity crisis, they have a, for example, repo, reverse repo, marginal standing facility, LAF. All these are some of the instruments through which RBI helps scheduled commercial banks and primary dealers to mismatch the short-term liquidity crisis, money crisis. Are NBFCs allowed? You have to have clear idea. NBFCs are not allowed under LAF with RBI. Statement 1 is wrong. Specific factual question he has asked where you have to have this clarity. FIIs, foreign institutional investors, can hold government securities. Yes, RBI has allowed and government has allowed FIIs to hold government securities like G securities, government securities, treasury bills. Okay, all this they have allowed. Stock exchange can offer separate trading platform for debts. Yes, stock exchange. For example, in India, major stock exchanges are which one? National Stock Exchange in Delhi and Bombay Stock Exchange in Mumbai. They can give separate trading platforms for the debt. Okay, there are equities. Equities are companies where you have share. See, it is linked with the last question. Debts are where? Bond market. Okay, usually more than 1 year. It might be 5 year, 10 year, 20 year bonds. Okay, debts can be separately traded in a separate platform. So here, statement 1 is wrong, 2 and 3 are right. Therefore, 2 pairs are right. Here option will be D. 2 and 3 are right. Clear? Understood? So, we'll go to next question. See, asked again in 2024. Again, the theme is repeating, debt market. In India, which of the following entities are permitted to trade in corporate bonds and government securities? G6, government securities, and corporate bonds. Company given bonds. Who can trade and who can buy and sell is the question. Insurance companies, yes. Pension funds, yes. Retail investors, yes. RBI has allowed. Which is the platform? eKuber platform. So these are the type of questions where you should be able to answer once you have clarity. Yes, insurance companies can be done. Pension funds, common man, retail investors also should have a chance to buy government security, treasury bills, corporate bonds, okay, to have a piece of it. So all of the above or 3 pairs is the answer. These are easy scoring questions where you should be able to answer if you have a mastery in economy basic concepts. So all can be done. This is retail direct scheme of RBI, which can be in eKuber platform where you can buy and sell government securities in the secondary market. So tell me, comment me, which is the primary market and which is the secondary market. You have to answer in the commentary, okay, comment section. Now again, identifying the financial instruments. Financial instrument is the single important theme where 1-2 question is repeating every year. Which of the following is considered financial instrument? Asked in 2024. Exchange traded funds? Yes. Motor vehicles? Is it financial instrument? No, it's a physical asset, right? It's a physical asset. Currency swap? Yes. RBI has an agreement with other federal banks for currency swaps. For example, Japanese bank, okay? Japan's bank. RBI has currency swap agreement in order to ensure that we are not relying only on dollar, okay? 1 and 3 are the correct options. Financial instrument, motor vehicle is a physical asset. So 2 pair are 1 and 3 here, okay? Vehicles are physical tangible assets. Clear? Yes. Seeing what is the level of economy and what are the conceptual basic clarities required. Need not study everything. Focused areas. Again, physical capital. Questions are on financial market, financial instrument, capital market, capital instruments, funds. Now, with respect to physical capital and working capital. Just basic difference between physical capital and working capital asked in 2024. So what is physical capital and working capital? See, physical capital will not be used up in the manufacturing process. Okay, it will not be used into finished product. For example, building, machine which produces parts. Here working capital like raw material which will be consumed. Okay, raw material which will be consumed to be made into finished products. Now knowing this, we'll see farmer's plow. Is it working capital or physical capital? Obviously it will not be consumed. It is not working capital, it is physical capital. Next, computer. Yes, it is used to work. For example, software company, computers are the assets or physical assets. Okay, fixed capital. Correct. Physical or fixed capital. Working capital, it is consumed. Yarn used by weaver. When you make, okay, dresses, yarn will be used. So it is not a fixed capital, it's a working capital. This is also wrong. Petrol, okay, when you are running a vehicle, it is working capital because it is consumed. So 1 is right, 1 is wrong, 2 is right, 3 is wrong, 4 is right. So 2 pairs are right, only 2. Fixed capital include long-term computer plow, working capital is used in production, yarn and petrol. Clear? Understood? So answer is 2 pairs. Next, with respect to how bonds work. He asked with respect to USA, it can be Indian bond also. If USA defaults on its debt, US Treasury bond holders cannot exercise claims to receive payment. Is the statement 1 given. We'll see what is the statement 2. The USA government debt is not backed by any hard asset but only by the faith of the government. Why is US dollar the important dollar in international trade? Answer in the comment section. Why USA government is not backed by any physical asset like gold? Why? That also answer. They were removed by gold standards and it was just backed by the USA government. And statement 2 and statement 1 should follow. It should be a following corollary. See whether corollary is matching or not. USA government is not backed by any hard asset, but only that I promise to pay you with respect to faith. Therefore, if USA defaults on debt, US Treasury bondholders cannot exercise, okay, claim to receive payment. Okay, so this directly explains statement 1. Understood? In government also, the government securities and treasury bonds, when you buy, government will just say that I'll pay you back. No security is there. Okay, the bonds itself act as a security. If they fail in India also, okay, bondholders might not get. Similar way, US Treasury bondholders might not get back. Yes, statement 2 is correct, and statement 2 explains statement 1. Answer is option A. It is backed by just full faith and credit of the government. It might be USA, it might be India. Clear? Next, syndicated lending dynamics. Okay, question was asked with respect to syndicated lending. What is syndicate? Okay, if you have seen Pushpa movie, okay, sandalwood or red sandalwood, Rakta Chindana, syndicate. Syndicate is group of, okay, group of companies with respect to here lending, okay, group of lenders. Syndicated lending spreads default risk across multiple lenders. Is it right? See the question. Say, if only SBI has given loan to Vijay Mallya, or if some 10 banks had given loan collectively to Vijay Mallya, then it spreads default risk. If Vijay Mallya defaults, that risk is spread to group of lenders. Correct? If only SBI had given loan, SBI is stuck. If some 10 banks have given loan, the default risk is spread across multiple lenders. For example, if big ticket, some of the projects which have huge risk, syndicate lending will act as a cushion so that one company or one bank will not be put under pressure. Second statement, syndicated loans can be fixed or lump sum but cannot be credit lines. If there are multiple banks formed a syndicate to give loan, it is telling loan can be just fixed or given one time, but it cannot be given as a credit lines. Like whenever you want, you can take the credit. Is it the fact? For example, if project is going and if it needs 1000 crores, there will be a credit line open based on the project you have completed. So this statement stands very commonsensically wrong. When you are building a house also, say for example, you need 30 lakhs, they won't give you at a time lump sum 30 lakhs. They'll open a credit line based on how you develop your house or project, that credit line can be used. So statement 2 is wrong. However, UPSC dropped this question in 2024. UPSC dropped this question. However, the answer will be statement 1 is correct, statement 2 is wrong. Statement 1 is correct, statement 2 is incorrect. Basic principles, and if you don't understand or if you don't know, if you're seeing it for first time, just see syndicated lending. Syndicate means they're forming a group, syndicate. By decoding terminologies, alternate investment funds, you'll be able to answer many questions. Next, capital market, again question. Consider the following: government bond market, call money market, treasury bill market, stock market. How many are included in the capital market? Please tell me what is the difference between money market and capital market. Major difference with respect to, okay, time limit of the instruments that are marketed, that are bought and sold. Okay, the instruments, money market are usually short term, that is less than 1 year. And in capital market, it is long term, more than 1 year. It might be 5 year, 10 year also, more than 1 year. So tell me which are short term or money market and which are long term or capital market. How many are included in the capital market? Government bond market. Obviously, government securities will be issued for 5 years, 10 years, 20 years, right? 10, 20 years. Yes, correct. Call money market. Call money market is a short term. If you have read market basic concepts, this is not a capital market. Treasury bills, T-bills are always less than 1 year. It can be 14 days, it can be 1 month also. So these are also short term. Then stock market. Stock market is obviously a long-term market or capital market. So two pairs, only two. Bond market and stock market deal with long-term capital more than 1 year. Call money and treasury bill less than 1 year. Money market. Clear? Two pairs is the answer. Here, with respect to investments, is asking which is tangible, which is intangible. We'll see the question in 2023. How many of the following assets are considered intangible? What is the difference between tangible and intangible? If you know this, okay, tangible or physical asset, okay, and they can be measured. Physical, see, basic concepts revolving around important basic things. Physical, measured, you cannot measure it. For example, sugar quantity, can you measure? Satisfaction, sweetness, can you measure? Okay, sugar in kgs you can measure. Satisfaction of a fruit or of a drink or of a juice or a sweet you cannot measure. Sweetness, okay, satisfaction you cannot measure. Tell me which of the following are intangible investments. Brand recognition, inventory, intellectual property, mailing list of clients. Okay. Brand recognition, yes, intangible. Inventory means how much stock you have, you can count. Intellectual property rights, you cannot monetarily put a value. Doubt was there in mailing list of clients. See, clients are always intangible assets. You cannot put a value. Okay, mailing list, 10 people, 20 people might be there, but that is not a quantifying thing. Here the quantifying thing is client, whether they are able to quantify or not. Here it is value driven, not quantifiable driven. So inventory is a tangible physical asset. Brand, IP, mailing list, all are intangible assets. Many did this mistake because they failed to simply understand basic concepts and basic terminologies. Here only 3 is the answer. So let's go to the next question. Defining beta. See, stock market or in capital market, you have stock market, which is always in news. So very important terminologies. And you should know the instruments like options. Many changes have been made. Futures, security transaction tax, STT, right? And T1 plus 1 cycle of settlement. Okay, all these are very, very important. Here you have alpha, beta, gamma, okay, theta. All these are there. Alpha, beta, gamma, theta are all the instruments in, okay, stock market. Terminologies used in stock market you need to know. So in the context of finance, the term beta is simultaneously buying, selling of different platform. This is called arbitrage. See, next question might come with respect to arbitrage. That's where options also become very important. Arbitrage, okay, in Nifty is top 50 companies in the stock market capitalization of India. You have Gift Nifty also. Gift Nifty is where foreigners can invest indirectly in Nifty through Gift Nifty. The difference between Nifty and Gift Nifty value can be used to make money. That is called arbitrage. Arbitrage, okay? Arbitrage. Simultaneous buying, selling on different platform using the difference in dollar or difference in value is called arbitrage. Investment strategy to balance risk versus reward. Systemic risk where perfect hedging is impossible. So what is hedging? You have to understand. Value measuring stock fluctuation relative to the overall market. Beta is a fluctuation term where relative change of value of a stock is compared with the change of the overall stock market. Overall stock market can be Nifty, can be Sensex, which you have heard. How Nifty and Sensex is changing, it is compared with individual stock market, individual stock value, and that fluctuation is beta. Understood? Futures, options, all the instruments of stock market which are always in news in the last 1-2 months becomes very important in economy. Basics which are not directly mentioned anywhere properly in the books but in the news linked to your static topics. Now, inflation index bonds, IIBs, asked in 2022. We'll see with reference to Indian economy what are the advantage of IIBs, again bonds, inflation indexed. That means inflation, you know, I think you know, I suppose you know what is inflation, I hope. Then they are indexed into the bonds. Every year RBI has 4% plus or minus 2%, okay, in inflation to maintain in this range, right? Monetary Policy Committee. Okay, this is CPI, Consumer Price Inflation. So inflation index bonds is, inflation is inbuilt or indexed with respect to bonds. Government can reduce the coupon rates. Coupon rates are nothing but interest rates, coupon rates on its borrowing with respect to inflation. Yes, if inflation is already indexed or incorporated into the bonds, government can reduce, can. Okay, if you don't know also, it is a possibility that if inflation is already indexed, coupon rates can be reduced. IIBs protect investors from inflation uncertainty. Yes, inflation is already built in and you have already target, then IIBs prevent investors from inflation, sudden shock and uncertainty. Now Iran crisis, oil shock is happening. No, if IIBs are there, it can offset this sudden shock. Interest and capital gains on IIBs are not taxable. Do you have heard of capital gain tax? Okay, short-term tax. You have to know those all things which are always announced by finance minister in every budget. Interest and capital gains on IIBs are taxable. If you know the basics, you'll be able to answer where 2 pairs 1 and 2 are correct and third statement, it is taxable. Next, we'll see. Consider the following again with respect to credit rating agencies. Okay, they will credit the bonds, companies, equity, companies means equities, ETFs, exchange traded funds. Okay, bonds might be so many, treasury bills, sovereign gold bonds, corporate bonds. All these are credit rating agencies will rank. Moody's, okay, Standard & Poor, S&P, all this will credit AAA, AA bonds, A, minus B, triple B, double B, okay. Credit rating agencies are regulated by Reserve Bank of India. Always UPSC plays with the, okay, authority. Credit rating agencies in India are regulated by SEBI, not RBI. Security Exchange Board of India. So statement 1 is wrong. ICRA is a public limited company. Yes, one of the credit rating agencies. It is listed in Bombay Stock Exchange, National Stock Exchange. Correct. Brickwork Rating is an Indian credit rating agency. Direct statement is copied and pasted. Yes. So 2 and 3 are the answers, or 2 pairs. Okay. This you need to have factual knowledge to answer this type of questions. So now you know which are the themes, areas questions are coming from. You should be able to focus your preparation there. Mechanics of convertible bonds. Okay, inflation index bonds. Now convertible bonds. Those are bonds, debt instruments that can be converted into equities if it is helpful for the lender. As there is an option to exchange the bond for equity. That is, you have given a loan and you have to pay back, but that loan can be used to buy as equity. I don't want the loan back, I will invest as money. For example, if there are some startups and if banks have given loans and if startups does really good, then if they have agreement that we'll buy the equity at this percentage, then that agreement can be exercised if startup does good. And if it doesn't, if it do not make good money or good revenue, then it can simply ask the bond to be repaid back. Convertible bond pays a lower rate of interest. As there is an option to exchange bonds for equity, convertible bonds pay a lower rate of interest. Yes, makes sense. Okay. If convertible bonds, if I am a company and I am giving convertible bonds to, for example, bank, that means that if I am successful, I have to give my equity which can be valued more than the loan I have taken. So that will attract lesser interest rate for the lender also. Statement 1 is correct. Statement 2, the option to convert to equity affords the bondholder a degree of indexation to rising consumer prices. Obviously, okay, you have given loan. When loan you have given, creditor will always face the issue of inflation. If you understood the inflation topic, see how inflation is linked to the bond. Okay, and if the option of convert to equity is there, then if company has made good money of the loan, then they are fighting the inflation and they are able to make more money. Here creditor is fighting the inflation, whereas the company is earning the money based on the loan with respect to real value, which is much more than the inflation rate. Therefore, the option to convert equity affords the bondholder, that is the creditor, to a degree of indexation. Correct? So statement 1, statement 2, both are correct. If you have understood the economic concepts very logically, you'll be able to answer very easily. Next, bond rate, inflation. Now bond yields. When inflation happens, what will happen to bond yield? What will happen to bond rates? You should be able to answer. Please comment, okay? And please answer what will happen. Indian government bond yields are just is asking whether going up or going down. No. Influenced by which of the following? Actions of US Federal Reserve. Yes. Our RBI Reserve also. Yes. Federal Reserve of US also is single one important action. Action of RBI. Yes. Inflation and short-term interest rates, that also yes. So close your eyes and you can go with all the 3 pairs or 1, 2, 3. All these factors will affect the Indian bond yields. Okay, Indian government bond yields. Now, debt infrastructure in India. Retail investors through Demat account can invest in treasury bills and Government of India debt bonds in primary market. Yes, I told already eKuber, RBI direct scheme, already as told in the previous slides. NDS OM, order matching, is a government securities trading platform of Reserve Bank of India. Okay, this is also right, eKuber platform. CDSL, okay, it is a depository jointly promoted by RBI and BSE. Always in authority, he will try to change it. No, it is not done by RBI. It is done by BSE and some of private companies. Okay, these are clearing houses. CDSL is by BSE and some of the other parties, and there is NSDL. NSDL is by National Stock Exchange and some other companies, not RBI. Same type of question was asked with respect to credit rating agencies. Statement 3 is wrong. Statement 1 and 2 is correct. So, 2 options. Understood how similar questions where authority is swapping or changing and is making that statement wrong. Next, interest coverage ratio asked in 2020. So, what is interest coverage ratio? See, if you don't know anything, just see the full form and try to make sense out of it. Try to make sense out of it. Interest coverage ratio of a firm. How much interest it will be able to cover based on how much revenue it is making, a firm. Right? Revenue or profit. How much money it is making, whether it will be able to cover its interest of the loan it has taken or not. Understanding present lending risk of a firm, that a bank is going to give a loan to? Obviously, what is the risk when it gives loan to? Whether it will be able to pay back the interest at least. Evaluate emerging lending risk of a firm that a bank is going to give loan to. Correct? Same almost statements. The higher a borrowing firm's level of interest coverage ratio, that means whichever company it is borrowing, interest coverage ratio is high. It can cover the interest that it has to pay. The worst is the ability. No, higher it can pay back, it is best, not worst. See, it has made ulta. Okay, contradictory statement. So statement 3 is wrong. 2 pairs, which is 1 and 2 only. Understood? Clear? Sometimes terminologies will help to understand the concept and to get the answer directly. So I hope this session was helpful. Go through the themes, go through the options and revise these basic concepts are asked. If you have clarity in the basic concepts, you will be able to get all the questions right in economy. So see you in the next class again. Take care.